So, you've finally done it. You put your hard-earned money into the stock market. Maybe you bought your first ETF, a few dividend stocks, or dipped your toes into index funds. Congratulations. That's a huge first step toward real, lasting financial freedom. But here's the thing. What you do after investing is just as important, sometimes more important, than what you invest in. One wrong move, one emotional reaction, can cost you thousands or derail your long-term plan before it even gets started. Today, I'm breaking down 8 things you should never do after investing. The beginner pitfalls seasoned investors avoid at all costs. Before we dive in, smash that like, subscribe for more wealth-building tips, and drop a comment with how long you've been investing. Let's grow together. Alright, let's jump right in. 1. Don't check your portfolio. Every day, daily prices swing on noise, headlines, data releases, even a tweet. Watching every tick converts investing into an emotional roller coaster, not a strategy. Example, you check 5 times in one day, see an 8% drop, panic sell, and miss a 6% rebound the next week. One impulse trade can set you back months. Action steps? 1. Disable brokerage notifications. 2. Schedule a monthly, or better quarterly, portfolio review. That's it. Recap. Wealth comes from time in the market, not time on the app. Set it and forget it. On to tip 2. 2. Don't panic. When the market drops, corrections of around 10% happen about once a year, bear markets of 20% plus show up every few years. Volatility is normal and temporary. Example, a 20% dip can take a year or two to recover. Investors who held or kept buying historically came out ahead. Selling low locks in pain. Action steps. 1. Write a rule now. I hold my core funds through downturns. 2. Auto-buy a small amount, at 5%, and 10% from recent highs. Recap. Don't sell fear. Treat dips like discounts if your plan hasn't changed. Breathe, zoom out, and stay the course. 3. Don't try to time the market. Time in the market beats timing the market isn't a slogan. It's backed by data. Even pros miss turning points. Example, miss just the 10 best days over 20 years and your returns can be cut in half. The best days often come right after the worst ones. Action steps. 1. Automate contributions weekly or monthly. 2. Avoid prediction triggers. No trades based on headlines or gut feelings. Recap. Consistency compounds. Automation beats guessing. Keep buying on schedule, rain or shine. 4. Don't ignore your investment plan. Hype is loud. Your plan is quiet. Meme stocks and hot tips can yank you off course in seconds. Example, give yourself a 5% speculative cap. If you want to scratch the itch, keep it tiny, so your core strategy stays intact. Action steps. 1. Write a one-page plan. Goals, time horizon, asset mix, rebalancing rules. 2. Impose a 24-hour cooling-off rule before any new buy. Recap. Follow the roadmap, not the noise. Plan the trade, then trade the plan. 5. Don't forget about diversification. Concentration feels bold until one stock stumbles. Diversification spreads risk across sectors, countries, and asset classes. Example, a lawsuit hits a single company and it lags for years. A broad ETF cushions the blow so your plan stays on track. Action steps. 1. Cap any single stock at say 5 to 10% of your portfolio. 2. Anchor with broad market ETFs for core exposure. Recap. Don't bet the farm on one name. Balance wins. Keep your eggs in many baskets. Dai. 6. Don't ignore dividends and reinvesting. Dividends are fuel for compounding. Cash sitting idle is opportunity lost. Example. Over decades, reinvesting dividends dramatically widens the gap versus price-only returns. Small payouts snowball into big growth. Action steps. 1. Enable DRIP in your brokerage settings. 2. Quarterly, confirm new shares are actually being purchased. Recap. Let dividends buy more shares, which pay you more dividends. That flywheel builds real wealth. 7. Don't overreact to financial news. The news business sells urgency. Your job is to separate signal from noise and stay aligned with your long-term plan. Example, a scary headline week, but the company's revenue, margins, and guidance are unchanged. Price jitters, fundamentals steady. Action steps. 1. Check the source and primary data before reacting. 2. Apply your 24-hour rule. No trades the day a headline breaks. Recap. The news is entertainment. Your portfolio is your future. Filter first, act rarely. 8. Don't stop learning. Your first investment is the starting line. Knowledge compounds. So does your confidence. Example path. Beginner. The intelligent investor. A random walk down Wall Street. Intermediate. ETFs, financial statements, asset allocation basics. Action steps. 1. Schedule a weekly 30-minute learning block. 2. Write one monthly summary of what you learned and one change you'll make. Recap. Keep sharpening the axe. Better knowledge, better moves. Outro. Call to action. So there you have it. 8 critical mistakes to avoid after you start investing. Avoiding these pitfalls is just as important as picking the right investments. If you found this helpful, hit like, subscribe to the Piggy Bank Chronicles, and comment which mistake tempted you most. Ready to build passive income with dividend ETFs? Watch the next video, linked on screen. Thanks for watching. Your patience will be rewarded. Time in the market beats timing the market. See you in the next one.